So we saw that rally coming through on Wall Street despite everything that we have just mentioned, or in spite of some of those things too. We're seeing pretty flat on the regional benchmark index now, but it comes to that question, is some of this bad news good news now for assets?
I think that's exactly it. So, we had as you said, the second quarter of negative GDP. Shouldn't have been a surprise. They rolled out Larry Summers earlier this week to talk about, well, it's just a rule of thumb that 2 negative quarters is a recession. And the market's taken it positively because it might mean that the interest rate cycle is not going to be as sharp from here as markets fear. Yep. So I think you hit the nail on the head there. And
in terms of the inflationary picture too, because we're looking ahead of that key figure coming through from the US Friday, we were just talking there about the likes of Elon Musk saying perhaps we have seen prices peak. Do you think that when do we see peak inflation here?
Yeah, well, except for the headline number, we've seen it.
Yeah.
So it's been a couple of months since core CPI has been declining, PCE data has all been declining, and as you said, we'll get the June number tonight. But it's the headline figure which is catching the headlines, and I'm not sure what exactly Elon Musk is looking at, but probably his input price inflation. And if that's peaking as well, then yeah, I think we're heading there.
Kieran, just more on your take on just kind of this scenario that we're seeing in markets, right? Where stock vols come down now. The dollar is weaker for a week. And we're seeing global stocks actually seeing decent gains for once. Is this really something that you think is a turning point for the markets? Or is it just really just positioning?
I don't think we're ready to say it's a turning point yet. So obviously the first half of this year was really tough for markets down equity markets down 20%. So certainly a lot has been priced in as a starting point. I guess there's really two big arguments going on in the market, and one is inflation versus interest rates, and we're now 4 or 5 months into the interest rate cycle, and we're seeing where things are going, and then we're also the zero COVID policies, particularly of China versus science. And it looks like, the Chinese government's being a little bit pragmatic and starting to slowly, if not certainly ease up on regulations, especially in Hong Kong, which is probably a test for what can happen in China. So, against all that, I think, you can be a little bit more positive on markets. We think it's, good time to be defensive against that kind of a backdrop. But we do think that China offers kind of a counter-cyclical opportunity, and we've become a little bit more positive on China in the last couple months.
Even with the fact that they're not going to try to hit that 5.5% growth target, you think that's actually a net positive?
Well, I mean, of course, higher growth is better, but I think it's catching up to reality. With COVID zero, with the 3 red lines policy, which is having such an impact on property markets, and without stimulus, there's no way that they're going to hit 5.5 anyways. So they just want to stop talking about it. But again, China's had a really tough year or more, and we think a lot is already in the price.
You're expecting the dollar, though, to continue to strengthen, which is kind of difficult for the Asian equity picture. Where do you see some potential areas that you might want to avoid at the moment?
Yeah, so with interest rates obviously higher in the U.S., the differential is positive for the dollar, and that's generally negative for Asia. I guess, one area where would be, I guess, not so much subject to that, again, is going to be China. So I think, again, the opportunity provided by the underperformance and the valuation opportunity makes China look pretty time to edge into China, and irrespective of what's going on with the dollar strength.
But to stay away from?
Yeah, I mean, look, it's pretty tough for Japan with yen where it is right now. It's, a lot is imported in Japan, so we think of it's great to have the yen so weak, and when they finally open up, let's all go. But for Japan, it's very tough where it is right now. So I think that would be the market to avoid.
What would it take for you to be a little bit more, I guess, pro-risk, I wonder, because you're talking about how people are pricing in this whole kind of Fed pivot scenario, and yet you're still staying quite defensive. What would it mean for you to kind of get more into the cyclicals and that side of the market?
Yeah, so I think what the risk is that we are heading into not just a technical non-recession or whatever we have right now, but a real recession. And if you look at the history of recessions in the U.S., since the 1970s, earnings fall by an average of about 25% peak to trough in an actual recession. And if that is where we're heading, that's the risk, because the performance so far this year has been all about multiple compression, and earnings are actually still higher. So if we're heading for lower earnings, that's the potential next leg down. That's why we think, until that's clear, we'd like to be involved, but in a more defensive position.